Welcome back to the channel. Today I'm going to share about how you can use StockPenguins.com's economic indicators tool and the Fed fund rate to understand how you can better time your investment entries, etc. So before diving into what the Fed fund rate is and how you can take advantage of it as a retail investor, I'm going to share about StockPenguins.com's economic indicators tool. So this tool is free to use, right? Where you can basically overlay any two economic indicators, or treasury rates, your Fed fund rates, and also any stock price chart, right? So in this particular case, I've already overlaid the Fed fund rate and the Nasdaq's price chart over the last 5 years, right? So we have data spanning back to up to 10 years where you can play around with, and you can even choose to export the data in the chart format in the PDF format if you want to, right? So let's get on to it. So what is the Fed fund rate? So if you haven't noticed yet or know, the Fed fund rate is being talked about every day in the world of finance, right? So the Fed fund rate, or often called the Fed rate, is the interest rate at which the US commercial banks lend their excess reserves to one another overnight, right? It is set as a target range by the Federal Reserve, the Fed, which is the central bank of the United States. So why is it important, right? The Fed fund rate is the benchmark short-term interest rate in the US financial systems, right? It influences virtually all other interest rates, including your saving accounts, right? Your mortgage rates, business loans, and bond yields, right? So you may think to yourself, okay, but how does this impact me as just a normal retail investor? Let's say if I'm not a business owner, I'm not a part of the bank, right? So as the Fed sets the Fed fund rate, it will also impact and spill over to the stock market, right? So for example, when the Fed increase the Fed fund rates, this causes the borrowing cost to increase, right? So which typically leads to your consumer and business spending to slow down, right? Because it's now more expensive to borrow to fund your big ticket purchases like houses, cars, or for business perspective, right? It's more expensive to fund new projects, new investments into buying a factory, for example, right? So this could lead to your corporate profits to decline, right? Because existing loans, especially if it's in the floating rate format, right, your interest payments will increase, right, as your interest payment rates increase, right? So this may tend to hurt stock prices. But if the Fed lowers interest rate, right, it leads to cheaper credit, more spending and investment, and the stock markets often rally due to the stronger growth prospects. So this is just from the business point of view, right? But if you think about it from the investment point of view, as an investment manager, if you are, say, managing a fund, right, and you're choosing what to invest in, so when there is a higher Fed fund rate, it usually means that your treasury yield is a lot higher now. So you could park your money into higher yielding assets at virtually close to zero risk, unless the United States blows up, right? But that's not likely the case. Versus when interest rates are higher, treasury yield is higher, you may choose to move some of your money out from the more risk-heavy stocks, right? Which you have to bear risk for the company to gain returns. But now your risk-free assets is providing more returns. It makes sense for some people to move their funds from stocks to the treasury and bonds, for example, and vice versa when interest rate is declining, right? So for long-term investors, the Fed fund rate reflects the Fed's stance on monetary policy, right? So again, rising rates means a tightening policy to fight inflation, right? So they're entering a quantitative tightening kind of environment, right? They raise rates, fight inflation, and then and when they cut rates, right, it's usually an easing approach, right, to stimulate growth. So as I mentioned, it all ties back to your higher rates and lower rates and how it impacts businesses and consumer spending behavior, right? So investors can use the Fed fund rate as a gauge for economic cycles, right? Estimate discount rates in valuation models and adjust portfolio allocations in between equities, bond, and cash. So, but in short, the Fed fund rate will ultimately impact the amount of liquidity in the market, right? So, as I mentioned before in many of my videos, I'm going to mention it again. As an investor, it's very important for you to know what kind of environment we are currently trading in, right? Are we in a very liquid environment, or are we in a least liquid environment, right? So, as an investor, you will want to park your money and let it grow most rapidly in the liquid environment, and vice versa in the least liquid environment, right, where you could be thinking of investing in something else which may yield better returns than stocks at the point of time. So the Fed fund rate is usually ties in with the fiscal stimulus policies in economy, right? So when federal banks usually cut rates, right, they will also have other policies in place to boost the amount of liquidity in the market through fiscal means. So for example, government contracts, things like that. Like government spends more, and particularly during COVID, right, there was a lot of free money given out to everybody to help tide through tough times, right? So this is when the Fed's balance sheet may increase, may widen. Yep. So it's very important to understand where we are trading at now, and the interest rate, the Fed fund rate, is a good way to gauge where we are at, right? So again, context and expectations are also very important, right? You don't just follow the Fed rates blindly, right? Because as you can see here, it's right like back in say late 2022, early 2023, right? Fed rates are still rising, right? But the stock markets have really bottomed by then and is recovering. So why is this so? So we have to take into context what's happening and expectations of the market participants and the Fed is very important, right? And number one of this, one prime example is, are we cutting into a recession or expansion? So based on Franklin Templeton's historical data, right, cutting into expansions is generally bullish in nature. And if you cut into recession, it tends to perform weaker initially, historically. So, for example, take into where we are now in the market, right? So, the Fed is actually cutting rates to fight weakness in the short-term job market. But usually, if you look into a rate cut, right, it usually means there's some weakness in the market, in the economy, right? But the stock market instead is just rallying higher and higher. So, why it is so? Because we are not cutting into a recessionary environment, right? So, the economy is still fairly resilient, which is why I think everybody's very confident about things going forward, and they're very risk on to invest in risky assets like stocks, right? And at the same time, you're seeing your risk-free assets yielding less returns, so it makes sense for everyone to just allocate to stocks, correct? And number two, what is the expected rate cut path going ahead? So if you use CME's rate cut expectations tool, you can basically see. Let me zoom in closer, right? You can see what is the target rates expected for the next cut, right? So now everybody's very confident that we're going to see 2 more rate cuts to end of the year, right? So as a retail investor, it's very important for us to understand the type of economic environment we are currently in and transitioning into, right? So these rate cut expectation bets are basically what the market is thinking of at the moment. So if you see, we are going to see a very strong confidence in the rate cutting policy and plan, then you'll see your markets rise steadily because investors are now more confident in how they can manage their portfolio. So for example, conversely, if you see an environment where the confidence in the rate path going ahead is very uncertain, when you see this kind of charts, seeing bar charts being evenly spread out, right, it could mean that the Fed isn't very indicative of their next steps going ahead, and then this uncertainty will spill over to the general investment climate, right, where everybody would wouldn't be that sure of what to invest in, so they would tend to be more protective in nature, right? So how do we know what kind of environment that we're going into? It's by understanding the economic data that we have. So CPI and unemployment are two most important data that the Fed looks at. That is their mandate, right? They want to keep they want to find a balance between employment and also fighting off inflation, right? So if you use StockPenguins, you could play around with the inflation-related data, employment-related data to see how it performs, or maybe you may even find something when you see any pattern spotting from the stock prices, single stock prices, and this kind of economic data, right? And number two is to know what the Fed is doing. Are interest rates going to be cut or hiked? Is there a path? Is the Fed very confident, right? Are we going to the quantitative easing environment or quantitative tightening environment? So what the Fed looks at is also this kind of data, right? All this data, and also to gain a better understanding of what they're doing, you could also read their monetary policy statements, listen to what the Fed chair is speaking and sharing during whatever his speeches that he's been invited to share, right? And ultimately understand what kind of liquidity environment are we at. If you're in a liquid environment, we can choose to be aggressive. In liquid environment, we can choose to be defensive. But to end it off, right, I think as an retail investor, we should always try to be ahead, right, and use valuations as a guide for your investment allocation. So don't just blindly put in all your money just because we're entering a very liquid environment, right? But always use valuation. Does the valuation still make sense for us to heavily invest now, right? And also to take into account valuations against current growth of big companies and their guidances, right? So yeah, you can play around with the economic indicator chart to see how the Fed fund rate actually perform against the stock market prices. So as mentioned earlier, usually if you are seeing a rate hike cycle, you see a stock price start to drop, right? But you see, you have to notice that the peak, right, it usually happens slightly before the federal fund rate changes. So all of this is indicated by your economic data, and also if you read statements of what the what the Federal Reserve is actually saying itself. So you get a sense of what the rate cut cycle is. And again here, right, the bottom is actually reached before the rate cut cycle even ends, right? So always take this into account. Always try to think ahead of the game. Use your economic indicators to guide you. And yeah, that's all for today. And let us know what you want to see next.